Hi everyone, it's Matt from Optimus Futures. We're going to do a little bit of a sound check and to see if you can hear me. Maybe you can click yes if you can hear me. I don't see anybody saying anything. I hope you guys can hear me. Hi everyone. Okay. I don't know why I hear it from here. Just bear with me 1 second. Okay. So I think now it's work. Okay. So thank you. All right. Well, thank you for coming in. Thank you for being on the show. I hope to make it very, very useful for you, and I hope to make it productive. And I just want to help you all out and discuss about day trading and everything else. So this is the first time I'm doing a live YouTube, and I didn't do it before. I'm going to try and answer any questions you might have as well. Before I start, I just wanted to tell everybody that there is a substantial risk of loss in futures trading. Past performance is not indicative of future results. You should only trade with risk capital, regardless of how much you believe in your method and your methodology. So, a little bit about myself. I've been in the futures business probably close to 25 years now, and I saw the evolution of day trading going from pit to day trading, and from pit to electronic trading, from online trading that enabled obviously today's day trading world. And I've seen a lot of good traders along the way and traders that make mistakes. I've gained a lot of insight into psychology, discussing things with people from all areas. I've discussed with things with people who have substantial retail experience. Some of them are professional licensed guys like Managed Futures. Some of them own prop shops, from all areas of life when it relates to trading. And so today I just want to bring you that experience to you. I hope this is not something that would discourage anybody from trading, but nevertheless, I want to be very realistic about the concept of day trading, and at the same time also help you become better traders. So why am I really doing this? One thing is I want to make you all better decision makers. I think that day trading, just like everything else, boils down to your decision making, how good of a decision maker you are. And this is not just a question of IQ. I wish I could tell you that every smart person would be successful in trading. It's a lot more than that, but we'll get into it. The second thing that I wanted to tell you is that, since I started in the business, when I started in the business, there weren't a lot of educators out there. There weren't a lot of people who were trying to teach you how to trade. There were very few, and everything was in books. Today, I think there's so much information. There's a lot of people who claim that they know how to trade, gurus, educators, vendors, software vendors, indicator vendors, everything on the planet. And I think it's a little bit overwhelming for the average trader, to cope with all the information out there. So I want to start narrowing it down to what's really important. And the third thing is, I feel there's a lot of social media sensation, right? So there's a lot of people out there that basically create a lifestyle around day trading, right? Everything is not necessarily about numbers. I've seen social media, specifically on Instagram, with all kinds of pictures with cars and tigers and leopards and fake watches, and they say this is how I day trade. And if you really get to know people who are day traders, you would see, and successful traders in general, you would see that they're very modest people. They're decision makers. They don't flaunt their wealth, and they definitely not interested in anybody knowing how much they're worth. So having said that, I want to help the community of traders. You can ask me any question you want. You have it there. Jake, our moderator, will help me with filtering which questions I should answer. I'm sorry if I can't answer all the questions, but you can always go to community.optimusfutures.com, and Jake will type it for you. Again, it's community.optimusfutures.com, and you can always ask me questions there. I will get to it. Sometimes it takes me a few days, but essentially I do like to answer questions, and I like to answer them with the type of pragmatism and practicality that you guys deserve. So let's start. Okay, so when it comes to day trading, I want you to stop thinking about markets for a minute. Don't think about markets. Don't think about S&P. Don't think about the series like TV shows like CNBC or Fox News or CNN News or that report news events, right? Economic events. I'm not talking about here about politics. Then you have the markets, you have the platforms, you have the variables like you have technical indicators and everything else. Don't think about that for a minute. Just think about a business where you have to take decisions, right? And when they say trading is a business, you will realize that over time what you have to do is really remove the news, and you have to remove distractions from your trading. And what you have to focus is on being a better decision maker, right? So a lot of people approach day trading with the idea of, I want to be a better trader. And I say, what you should really say is that I want to be a better decision maker. If you're a good decision maker, you potentially may have a chance being a good trader. If you are impulsive, if you're illogical, if you're temperamental, if you didn't do your homework, if you don't review your trades, then you don't have a chance in this market. And this market is extremely competitive, meaning that the people that are good at what they do are really good at what they do. So think of it this way. Think of trading as a business, and in every business, this is at least my opinion, in every sort of business out there are basically 10% that are extremely successful, very, very successful. They're disciplined, they know what they're doing, and the rest are kind of in the business, right? So in order to get to the upper echelon in any business, I think those people are really better decision makers. And there's a certain logic that they follow in their industry. And I think there's a certain logic that you should follow in the trading industry to potentially become successful. So I'm not here to promote day trading. I'm not here to promote futures. And I'm not here to downplay the risk that's involved in trading. In fact, I think that as we go forward, I think that technologically it will be easier and easier and easier for many people to enter into the market. Today you can trade from your computers and from your phones. However, I think the level of expertise that is growing in the business is also substantial. I think I've never seen so many young people today who are getting into the business. Granted, some of them are impulsive, and like I said, they follow social media and they think they're going to have a day trading lifestyle. But there is also a group that learn Excel, they measure performance, they build their own evaluation tools to see how they're doing. And so I'm very, very proud of actually the younger generation that's coming into trading, being very innovative in terms of how they approach and they self-taught. So the competition will also grow, right? So this is a competitive marketplace. In order to be successful in life, you have to be competitive. And competitive doesn't mean you think badly about the people that are actually doing well. Competition means that improving yourself. That's the only thing that you can do, is improve yourself, work better, have a great work ethic, right? So the same thing in trading. So let's start talking about how to make better decisions, how you start making better decisions when it comes to trading. So let's talk about that a little bit, okay? So day trading, the challenging part in day trading is that the minute you place a trade, you immediately know the results, right? You place a trade and right away it goes into a positive P&L and a negative P&L, or a negative P&L. And that affects you, right? That affects you psychologically, and that affects you immediately, and you start doubting yourself, right? And so it's important to understand, to separate the psychological part of trading with everything else. So let's talk about that for a minute. If you are extremely impulsive, right, in terms of your decision making, and what does it mean impulsive? Impulsive, I don't look at it as some sort of a. You might not be impulsive in life, but you might be impulsive in the markets because you sit in front of the screen all day, and sometimes the market moves in such a way that you don't want to miss out, right? So you go and you start trading, and you have to basically avoid that. You have to avoid the impulses that the market movement brings. You can only trade. This is where you control your psychology. Now, it's very important to understand that when I talk about psychology, let me tell you this. If you think you're in control of your own psychology all the time, then you're mistaken. Let me explain why. There's something called DNA. We evolved in a certain way. It took 1 billion years for us to get here. So there's a lot of things that we react because it's just part of our DNA. This is how we evolved as humans. So it's very important to understand that a lot of the stuff that happens, sometimes you have to be very conscious of your behavior. This is part of the struggle with trading, and I think this is the challenge, and this is where you can improve yourself, is basically asking yourself a question every single time. Is my trading impulsive? Did I react to it, or did I really wait for my setup to finish and complete? Was I afraid to miss out on a trade? What did I do? So those are things that are extremely important in your analysis of trading. You have to ask yourself, what motivated me to do the trade? So when you start analyzing that, there are 3 trades that are happening that you should analyze. One are the trades that you have taken, right? Second is the trades that you did not take, and what happened to the trades that you did take. Let me give you an example. So you analyze every day the trades that you took, right? Why you took them. You start looking at, and again, if you have some sort of a journal, it's better. I don't like to work with intuition. Intuition is not a good thing, especially not in trading. When people think that as traders evolve and they trade longer, they think they get a better intuition. I think experienced traders, what happens over time is that they learn not to trust their intuition, and they're learning to trust their method more. They're becoming more disciplined. They're trying to avoid any sort of an emotional reaction that's based on I think and I feel and that sort of thing. If you think that after 20 years of trading you'll be able to know better when the market is overbought and oversold, I don't think that's the case. I've been doing that for that long, and I don't know. So essentially what you have to do is really start relying on discipline. So again, you analyze the trades that you do, right? That's one thing. Now you also start analyzing the trades you didn't take, right? What happened to them? Because there's a fear factor. You're basically afraid to take certain trades, right? You're afraid to take them, and they could have been your best trades. So when you were afraid to take them, you have to ask yourself, why was I afraid? Look at all the trades I didn't take. Now, if you missed out on all the trades that you didn't take and they were bad trades, then you have to ask yourself, okay, why did it happen? Why? And if you missed out on really good trades, then you have to ask yourself the same question. Why did I miss out on those trades? Essentially, that question on the trades that you didn't take is just as important as the trades that you took, because it tells you how you react to the market. Maybe after 4 or 5 losses, the 6th trade will be your best trade, but that's the one you didn't take. That's the one you were afraid. Just let me bring that up. Sorry. All right. And the last trade, and the last thing, category in those trades, is basically to analyze the trades that you took, and you got out of, right? And to see what happened to them, right? What happened to the market after you got out of your trades, right? So that's also important because that will give you an idea if you were minimizing your profits and maximizing your losses. So maybe you're out too early. So you have to see, okay, what happened to the market after I got out of the trade? And that's extremely important as well. So this sort of an analysis is just one example that would lead you potentially to the next level of thinking and decision making, where you don't have to rely on your intuition, right? And again, I'm very much against it because I believe that there is a certain fear factor that when the market is out of control, that it would help you. But I don't think it would help you most of the time. Okay, so that's one thing. So essentially, you get into day trading, you start trading, and now the next thing that you have to think about is how do you measure your success? So success in trading is measured in a number of ways. And one of the way that it's measured is basically it's not only your P&L, it's also how you're able to recover from drawdown and bad decisions and things like that. So let me just get into this a little bit. Basically, traders that are day traders that are only looking at short-term trades, meaning at short-term time frames of their success, essentially limit themselves. And you can't just use one day to measure your success or a week. Now, I understand there's money on the line. I understand you don't have endless amounts of money to experiment. But it still does not take from the fact that trading is measured in terms of long-term success. What does it mean? It means that you have to evaluate it every quarter, every 6 months. And traders have learned over time that it's you have an average that you can achieve. You have a certain average, but that average is only built over long term. So what happens most of the time? A day trader comes in, is very excited, he paper traded, everything in paper trading went well, he goes into live trading and it's not working as anticipated. Well, let me tell you this, okay? There is a myth, in my personal opinion, that you can actually make a fixed amount, per day when you trade. It's just, in my personal opinion, it's a myth. You can take a long period of time, make an average out of it, but it does not mean that you can achieve it on a daily basis. So sometimes I hear people say, I want to make $200 a day, I want to make $300 a day. Now, whether it's achievable or not with your set skills, this is something that you need to decide. However, I'll tell you from a numbers perspective, if you look at successful traders, at least from what I've seen, they don't have that consistency on a day-to-day basis. I mean, maybe one day they'll make 0, maybe the next day they'll make 400, which will make an average of 200 in 2 days. But, they might lose 300 on the third day and then lose 500 and then make back maybe 700, right? So it just, you have to realize that you cannot control what you want to make, right? The only thing you can control is the risk that you take in every single trade. Now, I have to tell you that obviously risk, I have to talk about stop losses, and stop losses are never guaranteed to get triggered where you want them. They could be very hard, very difficult market conditions. It could gap, but let's assume under normal market conditions, you use your stop losses and it gets triggered, but that's the only thing you can control. That's basically it, right? Okay, I'll stop for a minute and see if you have any questions. All right, I'll continue. Okay. Let's talk about all the things that you need in terms of components for day trading. Okay, so first of all, you need to analyze a number of things. One, you have to analyze, well, before I go there, okay, everything that you do must be associated with logic. You have to be a logical person in order to implement a method. If it doesn't have logic behind it, it will not work. And what I mean by logic is basically the components have to make sense, okay? So essentially, it's like this. You have risk and reward, you have psychology, and you have mathematical probability, okay? Now, if your mathematical probability does not, how should I say that, does not make sense mathematically, it will not make sense in trading. Let me give you an example. So let's assume that you have a 2-point profit and a 2-point loss, right? Now, then it's a 50-50. It's like flipping a coin. The only thing that will come out of your account are the transactions, the commissions, right? So it doesn't make, that's what I mean by math. It doesn't make any sense. So yesterday, actually, I spoke to a guy. He says, I want to make a 1/4 point, and then I add another quarter, I add another market and everything else. So I don't know, he was building up positions, but the stop loss didn't change. And mathematically, it didn't, make sense, right? It just mathematically, it just did not make any sense that in the long run, mathematically it would make sense, right? So when you do things like that, what I mean by logic is that look at your trading and what you apply mathematically. And the easiest analogy is really flipping a coin. If you flip a coin 1,000 times, most likely that the results will be 50-50. It will be 50% heads, 50% tails. And this is the rule of numbers. So you have to apply the same thing in your trading, thinking, okay, if I do 1,000 trades with this risk reward, does it make any sense? All right, there's a question here. I'm going to just stop for a minute. Okay, how do you deal with traders fatigue? That's a really good question. So there's a number of trading fatigues out there, right? There's a fatigue when you take a really big loss and it exhausts you mentally. It depletes your resources. That's very tough. And then sometimes fatigue there is when you have huge wins and it's very exciting, and there's a rush associated. And the only way to really deal with that is really either to stop trading, which is really the truth. You can just take a break and you can say, okay, I don't want to trade anymore. I don't want to, I apologize. You just say to yourself, I'm going to wait until I get to a period where I feel better. And by the way, that leads me to another thing. Look, you don't have to trade every day. You don't. Being a day trader does not mean that you have to place transactions daily. You don't. You can't max out every single day and every single movement. And if you experience a certain level of fatigue, you just say to yourself, listen, this is not for me today. I'm tired. And if you're not focused, that's another thing. You have to be focused. You have to be, you have to eat well, you have to sleep well, you have to do all those things that are important for the human body. So again, how you deal with fatigue, you just stop trading. Really, that's the best way. If you're not focused and you can't take advantage of that, of the opportunities, if you can't take advantage of the opportunities in the market that week, it's fine. Don't worry about it. Come back. There's always the next day. So I hope it helps. Okay. So I see there's more questions coming in, but essentially what I would do, let me just go over some notes here because I want to talk about some other things. Okay, so I see the question here, the two questions, I'll address them, but I want to talk about something called positive expectancy. And again, that goes back to the numbers that I've discussed before. What you have to do as a day trader is stop being excited about good days and getting all depressed about bad days. There's no point in that, absolutely, whatsoever. And let me explain why. There's something in numbers called positive expectancy, which means that over time you will you have to make your trading results positive. However, it does not mean that it's on a daily basis or on a weekly basis. At the end of the day, like I said, it's longer periods, right? Longer periods of time that will tell you whether you're successful or not. And a lot of traders realize that. They don't focus on one day or the first day or the second day. It's irrelevant in the long run. Now, I understand that nobody has an endless amount of risk capital, but it's also important to approach it with the knowledge that positive expectancy is something that you have to apply to your day trading, right? So you have to think about numbers. And when you think in terms of numbers, then you start realizing, you say, okay, there are some of my trades have better odds and I have to sometimes keep on taking them. Now, let me tell you another thing about positive expectancy. And you should really look up this term, right? There's also the concept of opportunity cost. And opportunity cost is just as bad as taking losses. Let me explain. If somebody has a good method, and I've seen it before, somebody could have a good method in trading, but they cannot psychologically bring themselves up to trade it all the time because in between there's losses, right? But essentially, if they would have taken all the trades, they would have been positive. And what you realize in trading, that opportunity cost, meaning the trades you did not take, if you have a good method, are just as expensive as the losses. So if you have a method that you trade, unfortunately, you cannot skip trades, especially based on intuition. You don't know. And a lot of people do that. And again, I don't blame anyone, right? The whole purpose here is not to make you feel bad as if you're a bad decision maker. This is, everybody who starts goes through that, right? So the things that I'm talking about, please don't take it personally. And all the beginners go through that. So I'm just here to share that with you. So again, if you have a method and you've tested this method, and we'll talk in a minute about back testing, keep taking all the trades, and that's the only way you'll achieve potentially a positive expectancy, because you don't know when you trade what trade will be the winner and the loser. You just don't know. But if you have a method that you back tested and you believe in, and it's proven itself to work, then you should take every trade. So again, day traders, what they do, they focus on long-term results. That's what they do. They don't focus on a daily basis. They don't focus on a weekly in terms of number. Now, they analyze it all the time. They analyze what they've done throughout the day, what they've done throughout the week, but they're just not getting into the emotions of the day to day. Okay, let me answer some questions here. All right. Let me see if Jake chose one for me. All right. All right. So let me go to the first question. Okay. How mechanical are you with your setups? I want to be methodical, but I think that being rational and methodical is not the same as being rigid and mechanical. Where does discretion come into play? That's a really good question. So essentially, I would tell you this. If you see that, I believe in being rigid and methodical. I really do. And I can't talk about the mechanical part, because mechanical could be auto execution, mechanical could be technical analysis, it could be regression analysis. But I could tell you this, that if your numbers are skewed in a certain trading environment that do not fit that environment, for example, your profits are, and it could be reflected even in the profits. Your profits are too high. Your losses are too high. Something in the volatility of the market and the environment does not play well. And let's say you traded your system for a while, and I'm not talking about a day or two. Then look, you have to adjust it. You have to adjust it. So again, if we're trying to avoid the discretion part, that's the part where you still have to rely on numbers to tell you that this might not be the right environment for you. So you don't decide, okay, I'm not going to trade it. But if you see that you have a certain level of consistency over time in terms of your P&L, and all of a sudden all those numbers are skewed, then maybe the environment is not there for you. So this is where you have to go in and say, okay, you know what? The numbers actually reflect the fact that according to my mechanical system, this is what I am used to with the number of contracts. And then I'm looking at numbers that do not represent the past. So maybe something is off in this market. So then you can do two things. One, either you can stop trading or you adjust it mechanically to reflect it. Now, a lot of people say, look, I want to have a 3-point profit and let's say, 1.5 point stop, okay? Let's say it's a reasonable risk-reward ratio for some. Now, if the VIX is really, really high, and by the way, the VIX is the index that measures options volatility on the S&P. If it's really high, then you might, even though that's your risk reward, if the market is too volatile, then you're going to get stopped out all the time. Maybe you need to increase it to 9-point profits and 4.5 point loss in order to withstand the volatility. So that's where your discretion comes in. The discretion comes still in lieu of the numbers. I hope it answers your question. Okay. So there was another question. What should I look out for in a good trading platform? Good question. So basically what you're looking for is good execution. That's number one. That's the most important thing. It's not the prettiest one. It's not the one that, that has the most amount of indicators. First, it's good execution. I would tell you this, execution is important because everybody wants to lower their cost of commissions, which is totally understandable. We're brokers, we're trying to be very competitive in the marketplace. But I would tell you that execution is just as important. So you need something that delivers execution very, very fast to the exchange. Second, what you need is, that's what I think is important, is to know what every window does. You have to set it up in an easy way to see your charts, to see your P&L. You have to see the position that you have, the positions that you traded out of, so your trade position window. That's basically the most important thing out there in the trading platform. So speed and execution, knowing how to navigate through it, and at the same time, what's the last thing I wanted to say? If you have an interface that it's easy for the eye, right? If it's visually appealing to you, I would say that's very important. And just like execution, what you're looking for is stability. Stability of a platform is extremely important in my personal opinion. So those are the core foundations that you really should start from. By the way, we have our own trading platform. It's called Optimus Flow. Since we launched it, it's been, I could say that it's been really good. A lot of customers have traded on it. There's a free version, there's an order flow version, there's an advanced version. I'm not here to promote the platform, but since I asked, check out Optimus Flow. Okay, other questions. How do you know which futures is leading and following, like ES or NQ? I'm sorry to answer it that way, but it doesn't really matter. You trade what you feel comfortable with, Right now, it's obviously a lot of discussions of technology, so NQ, I think the price tells you which one is leading, right? You see where the volatility is, you see the direction. I think it's pretty easy. But what I think is basically, maybe you're implying with your question is, which one should you trade, right? And so essentially, trade whatever you feel comfortable. Okay. How do you decide that the day is good for trading and you should give it a try, let's say, to NQ or AS or RTY or nothing at all? I can't answer that question, to be honest with you. I can't because I don't know your method. So you really have to look at the markets and the ranges. Like, for example, let's use an example. Okay, so the day starts, right? And maybe you wait for a certain range in the first 2 hours to tell you whether it's a market, that you want to trade, or you don't want to trade. You see the volatility maybe within the first 2 hours. So again, those kind of questions are basically relying on intuition. It's like, oh, it's too volatile today. Oh, it's too quiet today. I mean, again, it's your method that you have to decide whether to trade it or not, and you have to have some sort of a parameter that will tell you that. All right. Let me continue here a little bit. So here are some questions that I wrote down. Okay, that I think you should ask yourself, and maybe it would help your question as well as knowing when to trade or not. You have to. Here are a few questions. So it would help you decide whether you want to trade that day or not. So, what does the market think? What are other traders doing? What is the probability of the market going up or down? Am I being realistic now? How much do I stand to win or lose? So basically, just remember you're trading against other customers and other traders, and it's a game where except for the transaction cost, it's a zero-sum game. So those are the questions that you really have to ask yourself. And the last question of how much do I stand to win or lose, or the one before that, am I being realistic right now, are really important because it tells you the risk and reward out there, right? So, I'm going to point out to an article we wrote about day trading and the 14 benefits of day trading. Jake will post it at the end of this webinar, and you can take a look at it as well because it's part of it. So don't feel bad if you missed out on some of those questions that I just mentioned. So one of the things that I get asked a lot is, how do you handle this situation or this market and that market? And beginner traders don't like the answer of it depends, right? But that's the right answer. And I always answer that way. And I'm going to explain to you exactly why. So when it comes to the market, what's really important is the concept of context. How did we get there, right? So when you say we got to the price of 5, how did we get to the price of 5, right? Was it fast? Did it skip from 1 to 5 and the market gapped? Was it slow? 1, 2, 3, 4, 5? Was it 1, 3, 5? So in understanding how to handle different markets and different situations, you really have to think about the context of the market. What's going on with the price around it? How the volatility is acting. And that would lead you to better decisions, right? Understanding the context that you're in, the velocity and the speed that the market is moving. So let me give you an example. Let's say a market has been trending up slowly, right? And so somebody wants to go long that market, right? Because it's slow and it's been building up. So it's logical for somebody to go long. Now, if the market got there really fast, right, to the same price, just this, look, let's say that we have a price of 0 and 5, okay? So we have 0 and it went there 1, 2, 3, 4, 5. Or it went 0 to 5, right? Now, you ask yourself, where's the probability of a better trade to go long? That's what you have to ask yourself with that sort of context. That's your context. Context is how the market got there. So if you went 1, 2, 3, 4, 5 and you went long, I would say, in my opinion, it has a better probability in terms of potentially going higher versus something that went 0, 5. Now, I'm not saying that if it goes to 0 to 5, it won't go up afterwards. I'm not saying that. We don't know the future. But the context is important. So for example, for myself, I could say, in the context of 1, 2, 3, 4, 5, I feel more comfortable going long as opposed to 0 to 5. I'll tell you why. Because 0 to 5, maybe there were a lot of shorts that were stopped out. And that's it. And the market was over then, right? Maybe there was some huge buy that went into the market at the time and they finished and the market will resume to what it was doing before. As opposed to 1, 2, 3, 4, 5, where there's accumulations of buyers for some reason, right? And maybe somewhere later on in the price, there will be more buyers and the shorts will get stopped out, which will increase, which will lead to potentially a better price level. So the context is extremely important. How we got there, what's the volatility, what the market did before, a day before, a week before. So all those things are extremely important. Okay, so I'm sorry, I'm just gonna lower this. I'm not sure why it's keep on going. Okay, so let me answer some of the questions here. All right. I answered that as far as execution goes. Okay, so as far as the execution goes, don't most of the order routing companies have servers at the exchange? No, not necessarily. All the orders will go to the exchange. It does not mean that the orders will always sit at the exchange. Some do, some don't. CME, for example, has 2 data centers. One is located in Cermak, which is downtown Chicago. The more advanced one, in my opinion, is sitting in Aurora. So, again, and then you have companies that might have a server in New York that it routes through New York to Chicago, which adds latency. So, to say a general blanket statement that all of them have it there, I wouldn't agree with that. Okay. All right. As far as execution go, okay. Should our trading plan be written and reviewed before trading? Great question, and absolutely yes. So you should be prepared every day ahead of tomorrow's prices. Because if you don't, then you again becoming impulsive. So if you plan at the end of the day where to put your targets, where to put your stops, where to put the limit orders when they happen, it is way better than actually coming to the market the next day and trying to see what it does and decide from there. Potentially looking at the prices, you don't know tomorrow's prices, but you can look back and see how prices behaved around a certain level, if there was support or resistance. So definitely, it's important to review your trades at the end of the day, and it's important to also be prepared for the next day, saying, okay, if this happens, if this price level hits, what am I going to do? If this hits, what am I going to do? And those kind of questions are very challenging, and you challenge yourself, right? And this is what I'm talking about, developing as a trader, not being impulsive, but being prepared ahead of time. So great question. And yes, you should review your trades every day. Now, I've noticed, maybe I'm wrong. I don't like to generalize things, but so I'm also, because I talk to people all the time and are retail traders and customers, but it seems to me that a lot of people analyze more potentially when they're not doing well. Am I correct on that? Like, do you guys analyze more, right? And so that's what it seems. But I'm going to tell you this. It is so important to review twice as much, in my personal opinion, the trades that you've done well on. Very important. And I'll tell you why. Because our brain is basically likes patterns, and it's drawn to patterns. So if you teach your brain, that you are drawn to success, it will be drawn to success, and vice versa. And when you only review trades that are losing trades, this is what the brain gets attracted to. And again, I'm not a psychiatrist, but I want to tell you, you see all those books over here? A lot of them are not trading books. Let me tell you this. A lot of them are books that I bought in order to be, like I said, a better decision maker. And to think positively and to reinforce habits of good potential day trading, what you need to do is force yourself as much as you can to, even if it was slightly positive day, to ask yourself, what have I done well that day? Where did I put my levels? How did I act with my risk reward? As opposed to just analyzing on days when you're bad. If you don't analyze at all, that's the worst. If you just come every day, you trade and everything else, kind of looking, thinking that from the back of your mind, trying to analyze how you traded, that's your analysis. That's not how it goes. You actually need to put in an Excel spreadsheet to put your buys, your sells, look at them. You have to write it on paper, how mentally you felt when you did well. And at the same time, when you review bad trades, it's fine. You just say, this is a mistake that I've done and I'm not going to repeat it, right? And just because you did it once, you said you're not going to repeat it, let me tell you, it's not going to help. You have to write, you will make the same mistake 30 times until you decide, and I'm talking from experience. The same thing on the good trades. Just because you had a good trade and you analyze it doesn't mean it's in your DNA yet, right? So I can't emphasize enough how important it is to review your trades. Okay. Okay, so does Rhythmic have a server in Aurora? Yes. Can you talk about the pros and cons of scaling in and out of trades? Okay, so to be more specific, you mean like pyramiding trades? Like you go in and you build another one, another one, another one? If I assume that's the case. So what I wanted to tell you is that I'm not a fan of scaling into positions. I'm not against it. I have no proof that it doesn't work. It just I don't like it. I think it throws you into a different risk and reward scenario that could potentially might play around with the numbers, right? So I'm not a fan of scaling positions on pyramiding. Unfortunately, I didn't see any proof that something that could work. Now, what you can do potentially, okay, if you have, and again, this is just a suggestion, right? And this, as I say, past performance not indicative of future results. But here's a suggestion. You could, let's say you want to build up a position to 5 micros, right? You want to do one micro, and then second micro, third micro to, let's say, 5 micros. What you can do, instead of building up the positions, because in my opinion, in hindsight, when we analyze, everything works. Every method works, right? I'm yet to see somebody who lost money in paper trading. But, in real life, considering that we have our DNA and our nature and as Asians, it's very hard to scale. But here's a suggestion. Let's assume you want to build up a position of 5 on something, right? Up to 5 as the price progresses in your favor. What you could potentially do is maybe go in with a small number of contracts. Maybe you do just 1, okay, or 2, and you say if the price starts moving in my direction within a certain time period, then I'll add the other 3. As opposed to market goes up, goes up, goes up, goes up, and you keep on adding. Remember one thing about the markets. The reality of the markets is that they are there to scare you away. That's the truth. That's why you have volatility in the marketplace. The job of the market is to scare the weak hands. So when you scale in, I think at some point there will be too many people that are long or short, and the market will just correct it. So you have to excuse me, not a big fan. Sorry. Again, not against it, just being honest with you. Okay. So I see there's a lot of technical questions here. Okay. Rhythmic has Chicago and Aurora servers. Which should I use connecting from Toronto? Aurora. I would say, you're on the East Coast, Toronto, great city, by the way. Snows a lot, but nevertheless, great city. All right, let's see what I discussed that. Okay. So somebody asked us about preparations, right? Okay, so I got a few good points about preparation. So you definitely prepare for tomorrow's day session, and you want to look at the current environment, the short-term trend, and the long-term trend. So when you trade and when you day trade, a lot of people look at short-term. You're welcome. Love the logo. That's C. So this probably stands for the Canadian dollar, the loonie. So what you want to do is basically look at a number of day trading time frames. Let me give you an example. So let's say you trade from 5 minutes, right? You trade a 5-minute chart, and on a 5-minute chart, you have this is where you make the decisions from. You should still have a 15-minute time frame and 30 minutes. Maybe you want to have 30 minutes and 1 hour. Don't know. But have at least 3 time frames. One that you trade from, right? And one other ones for reference. Because I believe that longer time frames are very relevant for support and resistance. So what you want to do is not just confirm with one chart, you want to confirm with a number of charts, right? As far as support and resistance. And again, we don't know the prices, once we place the trade, right? We don't know the future. So part of decision making at the end of the day, if you have logical decision making, in my opinion, you increase the odds, right? That's all you can do. It's just increase the odds of good actions, of good decision making, right? Okay. Let's go to the next one. Okay. I spoke about it a little bit briefly when we started, and I want to go back to it in just 1 minute, but I'm going to tell you this. What you have to do is really avoid deceptive market moves. What does it mean, deceptive market moves? Now, obviously, they might have been deceptive after you got in, so you can say there's a little bit of a hindsight statement, which I would agree. However, don't react just because the market started moving really fast, up or down. Don't react. If you see a market that is in a certain fluctuations and has a rhythm and suddenly does this, don't react. Don't do anything. Do not do anything. Most of the time, the people who do get into those trades are in a state of FOMO, right? They are in a state of fear of missing out. And this is how they trade all their life, right? They're just in a state of, the market moves, oh, I'm there. And those are the same people who move from futures to stocks, from stocks to stock options, then ETF, then they say maybe Forex, and they just repeat the same mistake on every asset class, thinking that a different asset class would require a different set of skills. So again, anything let me summarize it this way. And again, you have to be very self-conscious of your behavior. So anything that triggers emotions, okay, do not react. Just don't. If it's not your method, don't react. And if you miss out, it's better, because what you're trying to do, what you're trying to do is build a character. What you're trying to do is really get to a point that those kind of things don't even affect you, right? You're just cool. You're just cool about it. It's like, yeah, it happened. So what? It happened. You don't feel like you missed out on something out there. You just say, listen, it is what it is. And when you see that there is a certain behavior associated with financial reward, you're going to say to yourself, yes, that works. And I'm not going to do the stupid mistakes. Now, I'm going to tell you this. Being a day trader is a career. Being a day trader is just like an athlete. You can't stop. When you stop, you stop. You retire, you retire. But as long as you're in it, lifetime commitment to become a better decision maker. This is what you're in for. It's not going to happen after, you're not going to wake up in 5 years, you're going to say, I know the markets. Nobody knows the markets. You will be a better decision maker, but you will not know the market. So the constant analysis is really important, and I feel that a lot of people in the beginning of their career deplete their emotional resources and deplete their capital based on those deceptive moves all the time, because they just wait for that move and they go in on some sort of a emotional trigger. All right. The sites which teach good price action and future market. Right. Okay. It's called Amazon. Great site. So, okay. That's one thing. Okay. The other thing is, you have what I've noticed from good traders, that they're extremely competitive. And I know I spoke about it before. Now, competitive means that they work really, really hard to improve their skills. This is what competitive really means. And people who are day traders and successful day traders, they go back to it every single day, right? They go back to it every single day to analyze what they've done. They analyze, sorry guys, I'm just gonna have something pop up. They go back to their actions. They go back to the decision making. They look at what the market did. So you have to be extremely competitive to be successful in this market. Now, if you don't come from a competitive discipline, let's say not all of us came from, military or sports, or where discipline is extremely important, or being in the corporate world, meeting deadlines. Some of us, some people are still young and they didn't develop, they weren't exposed to any environment that they weren't exposed to any environment that was high pressure environment. And competitive people who go into trading from those kind of environments, I think they have a little bit of an edge over others. So my recommendation to you, develop something else along with trading that requires discipline, whether it's changing your diet or going to the gym. My discipline is reading books. I force myself to read all the time. I have to do it. I have to read books. I mean, and if I don't read, I just don't feel good. I mean, I mean, for me, it's like a person's lifetime experience summarized in a book, and he shares everything with me for $20. I mean, so again, this is my discipline, is reading. You develop a different discipline outside of trading. Do something that would help you. Maybe you need to change certain habits outside, and it will, in my personal opinion, it would go into trading. I mean, it would somehow, those habits would spill into trading as well. Maybe not on day one, but hopefully over time. Okay. Okay, so the question is, how long do you take a trade for? Say you're in a long. How long will you stay in the trade for? A few minutes or hour? Or how do you like to trade? Great question. I actually wanted to talk about it and I almost forgot. It's been an hour. Should we keep going? All right. So, okay, I guess it's an hour. We'll keep going. Okay, so the question was, how long do you take a trade for? Great question. I'll explain why. In my opinion, if you are trading, the length of the trade, the time of the trade that you're in a trade, the length of time that you are in a trade should really depend on your time frame. Let me give you an example. If you're trading off a 3-minute chart, it's illogical to be in the market for an hour. It's just illogical. I'm sorry. It just doesn't make any sense. If you're trading a 5-minute, right? Even if you're trading off 5 minutes and you're in a trade for an hour, it does not make any sense. Let me explain why. A lot of people look at trading, right, as a profitable trade, as a trade that made money. But let me give you a different angle on this. A profitable trade is a trade that you made a good decision on, that was associated with some sort of mispricing in the market. The market corrected itself and you got your reward, right? That's what it is. And when you trade of a 5-minute chart, right, doesn't matter what your method is, you're there to exploit some sort of a mispricing, and hopefully when you're in, it will correct itself. But the more time passes the less likelihood that this advantage is still there. So I would say this: if you are trading any time frame you trade, your length of time in the trade should be, again, this is just my opinion, you don't have to take it. I want to tell you, when I say you don't have to take it, I know everybody listens to me and say, well, you've been doing this for so long, but I'm going to tell you something. Your trading could evolve in a completely different way. I'm not here to tell you, the rules are very specific. I'm just to instill a certain discipline in you and just throw logical ideas. But this is my opinion, that if you're in a trade, you should not be in a trade more than 3x. Let me give you an example. If you're trading a 5-minute time frame, you should not be in a minute more than 15 minutes. If you're trading 1 minute, you should not be in more than 3 minutes. Let's assume it's very short, maybe maximum 4x, right? So if you're trading, let's say, an hourly chart, then obviously you can be in the market for 3 or 4 hours. That makes sense. But usually I would stay with the guideline of 3x your time frame. I hope it helps you. By the way, just who asked this question? Okay, how long you're in the trade? So Ekman Dick 02. So just to let you know, on Optimus Flow, I've actually added specifically for that, because this is how much I believe in it, an indicator that you can actually go and say, I'm in the time frame, please alert me after 90 seconds, alert me after 300 seconds. And basically it throws a button that says, your 300-minute reached, do you want to get out, right? Majority of the time, when people get into a trade, when it's in a loss and it's not in a win, then they stay in it. They're like, I don't want to get out. But essentially, again, it's opportunity cost. You're not out. You're not looking for new opportunities. Time has passed. You trade off a 5-minute chart. You're an hour in the market. You've done nothing, right? It just fluctuated. So what you really missed on is opportunity cost. Maybe it made you a little bit of money. But again, time frame has to be relative to the time of the length of time that you're in a trade. So again, great question, and thank you for asking it. All right. What if you're trading? There's always a guy who would ask me something completely impossible. What if you're trading the 1 second time frame? Okay, so I listen. I don't know how to trade 1 second. I'm sorry. I personally don't know. So I'm not saying it's bad. I just don't know. When you say stay in the trade for 3x, do you apply this even for trades that are profitable as well? Yes. I mean, unless you have a runner, unless you got into a trade that it just simply starts running in your direction and you can play with it. Yeah, I mean, listen, once you do it, you apply it through all, right? Because if you start being selective, oh, this trade is making me more money, so I'm going to stay longer. Again, it's a great question, and so this is from Pradeep Tumati, right? It's a great question. But I will tell you this, and by the way, Pradeep is a great trader, so he comes from a place of experience. I know Pradeep. So the answer that I have is this, you have to check your numbers over time. Let's say you have enough, and you can do stats. So if you're in a trade and let's say 3x, so you're trading off 3 minutes and you're in a minute 9 trades, check your numbers, see what your numbers have told you if you should stay in a trade or not. You might find out that I'm 100% right? You might say, okay, it really would have been better if I got out faster, or if it's a profitable trade, you can say, you know what, in those times I can actually stay 5x versus a losing trade. So again, just your numbers will tell you everything. And again, my truth is not a universal truth, but it just gives you the logic of, if you're trading off small time frames and you understand that you're trying to exploit a price move, a mispricing, right? Then how long was this mispricing is going to exist, on a small time frame? That's what I'm saying. Okay. Okay, so there's a statement here. Everybody is going to have a different technique. What works for one doesn't work for another. Agreed. However, I would tell you that whether you are trading long-term trends, short-term trends, medium trends, the successful traders, what's common to them, it's their discipline. The method might be different. The way they apply it, I find across the board with their discipline is the same, right? They find the method, they stick to it, they periodically could adjust it based on volatility, but again, there is a commonality to successful traders. Okay, let's see if there's anything that I wanted to mention. Okay, so I wanted to, I guess we passed an hour. I don't want to keep you longer. I just want to mention one more thing, okay? So when it comes to trading is not about predicting future prices. It's not trying to predict the future. And you might say, well, that's a little bit contrary because, when I go in, I go long or short, I'm trying to predict, whether the market is going up or going down, which is true. However, what you have to do at the end of the day is that the statement that I said still has truth is that once you enter the market, you do not know whether the market is going to go up or down. So, and you have to be prepared for everything. So the only thing you can do, again, forget the fact that it's a market. Just forget the fact that it's a market. Just think of it. Let's make it so simple. Let's say we have a dot that goes up and goes down on the graph. It doesn't represent anything. It just goes up and down and it just fluctuates based on something, right? And so the minute you enter into a trade, you do not know. You want the market to go up, right? But sometimes it doesn't. Now, why is it important to understand that you're not there to predict the market? Because if you are trying to predict the market and you went long on something and the market starts to collapse, or you went short and the market starts to go up, right? And you're saying the market is illogical, it doesn't make any sense, and the market is stupid, right? But yeah, the market is stupid sometimes, and sometimes it's illogical, and sometimes it's smart, because if it had just one character, we would all be billionaires, but we're not, right? So essentially, the only thing you can manage are your actions. That's the only thing you do. When you get into the market, don't try to predict if it's going up or down. You just have to handle what the market gives you at that point in time. And it took me many, many years to realize that. This is not some sort of a thing that I said, hold on, everybody, what is the source of many of the mistakes that people do? It's because they build up ideas in their head that the market should do what they expect it to do. It doesn't work that way. Just because I want something to happen doesn't mean it would happen. And can the market be stupid? Sure, it can be stupid. We recently had a case of JCPenney going out of business, and all the Robinhood geniuses went and they bought into a stock that was bankrupt. I mean, so they did it. Does it mean it will go up? Well, maybe. Is it logical? No. So so the idea is not to try to predict the future, and you try not to and you try to control your emotions that way as well, right? And so again, that would also help you become a better decision maker. How to pick the best brokerage? You're asking a broker from Optimus Futures how to pick the best brokerage? I mean, listen, what do you want me to tell you? Try and engage with us, see if we're any good. Visual versus, okay, so there's a few here. Here's a question. How important is screen time, in your opinion, for an aspiring futures trader? What I mean is, should I buy a bunch of cheap TVs and put DES 5 minutes chart all over my place? No, you shouldn't do that. Don't buy a bunch of TVs. When they say screen time is important, they really mean trading. De facto, real trading, being in the market, that's what real screen trading is. It's not watching the markets developing some sort of intuition. Not going to happen. Markets, yes, they only go up and down, but the way they get there, the way they correct, every year could be different. Just by staring at prices all day, to me, it doesn't do anything. It's not practical. You can paper trade, and again, I'm not going to go into the whole area of paper trading because a lot of, in my opinion, 99% of the time, people who paper trade don't paper trade right. And I mean 99%, just my opinion. That's why they have such a shock going back into the market. You're better off having one TV, so I just saved you like $10,000. And you can have on let's say one screen market replay. We have market replay on Optimus Flow. Watch what the market did. Try to guess where it's going. Press the replay. It would help you. In my opinion, market replay is better than paper trading. Okay. How important? Okay, so that's screen time. Visual versus fixed stop. Tough question. Very tough question. I wish I had an answer. I don't like the concept of visual stops because I believe that beginners, many times, even if the stop hits, they were just not going to get out. They're just not going to, it's just not going to happen. Again, just reminding everybody that stop losses might not get you out at the price of the stop. There could be very tough market conditions and markets could gap. So stop losses are never guaranteed. But to answer your question, it's tough because on one hand, I hear people that say, look, my stop's getting triggered all the time. And I say to them, listen, maybe you're putting them in the wrong places, or maybe they're too small, or maybe they don't fit the volatility of the market. But you can't avoid them. Not putting them. Look, I would say if you've been trading for a very, very long time, but even then, what's the point of not putting them, right? I mean, I can't find an argument for it. I know a lot of people, again, argue that they get stopped out, but I would say that if they don't put the stops and the market gets there, they say, okay, let's wait, maybe it will bounce. And maybe one time it will bounce and it will trick you, but then the next 9 times it won't bounce. So it's important to have risk management. Sorry, I don't have a straightforward answer. You have to decide for yourself. Okay. You're very welcome. Okay, so Ebert Mahone said, wow, 99 paper traders wrong. Oh, yes, wrong. I don't have time. I hope that I'll make more live sessions, but I'll definitely, maybe on the next one, I'll discuss it a little bit in more details. You're more than welcome to go to community.optimusfutures.com and I'll try to answer it there. And again, all of you that if I said something that you agree or disagree or you want to further your points, again, go to community.optimusfutures.com. Post your questions there. I'll try to answer it. Okay. Okay. Thank you, Matt. Excellent discussion. Thank you. I appreciate it. Is it true that futures traders are first come, first serve? If so, someone has a stop already in place, it will be filled before a server order placed. Yes, it does work on a first come, first serve, right? Essentially, it's more important in limit orders. It's just Murphy's Law. When everybody has stops, everybody gets stopped out, but limit orders are really more important. So yes, latency is extreme. This is what I said. Latency is very important because you obviously want to get, be the first to place the trade. Okay, so aren't the micros a good way to trade live without risking much? They're definitely, I cannot downplay the risk in the futures market, and I don't want to. But definitely the micros, it's a fact that they're notionally smaller and they provide a much better learning tool than trading with fully leveraged products. So I fully agree. Let me see if there's anything else. No, I think I pretty much covered everything. If you guys have any more questions, I'll be more than happy to answer it. Somebody said, I listened to your interview and chat with traders today, one of the best. Thank you. I appreciate it. I did it a long time ago, but as you see, I have a certain tone that I take with new traders, and I'm really trying to be as honest as I can about the challenges of this market. I want you guys to do well. I know I can't help everyone, but at least I wanted to say that as a broker, I gave you the right tools to think with. So let's see if there's any more questions. I listened to, okay. You're very, very welcome. Somebody says I don't use stops, I use confluence of support and resistance indicators. Okay, listen, if it works, like I said, if you're experienced and it works for you, I'm fully supportive. Okay. Okay. How much do you think a new trader should target to become consistently profitable? In terms of time, everybody has his own, skill set. I don't know how much time. I can't answer it, I don't know how much time you dedicate to it, so I don't know how much time, it will require. So, okay, so the ES is pegged to the Dow during normal hours. Watching both at the same time works great for me. Any thoughts? Listen, if something works for you, I don't have any thoughts. You shouldn't ask anybody anything. They say that trading is a lonely sport. It should be a lonely sport. When I see traders go on forums and they say, what is the best time frame to trade the E-mini? They use the best. What are the best books? What are the best courses? Anything out there that you get in terms of knowledge, whether it's books, courses, mentors, indicators, expected to give you about 10%. That's exactly right, 10%. If you think that any trading education you can actually make them responsible for your success, you're wrong. It will add just about maybe 10%. And all other elements will be built up over time. Nothing beats experience. Nothing. No courses, no indicators, nothing. Just pure experience in trading. Okay. How much performance in a percentage does a good trader per year according to your experience? I'm going to tell you this, and I know you're going to hate this answer, but it depends. It varies. Some, I would say, I'm talking about the good traders. Some are above average and come up with very high returns. And some are trading with, and some are trading with the same returns as the stock market, which is about 8% or something like that, right? It just, that's what it is. So everybody varies. The one thing I would tell you is this, is that it's very, very hard to achieve above average returns as you increase the number of contracts. So a $10,000 account, let's say, hypothetically, let's say it grows, to 20,000, which is 100% return, right? Try to do that with $1 million. Try to duplicate the same thing with $1 million, and you'll have a very hard time. So scalability is extremely important when you talk about success. You could potentially, and I'm not, downplaying risk, take 10,000, make 10,000, remove the 10,000, make 10,000, say every year I made 100%. But as your numbers grow to 50,000, 100,000 and higher, it's extremely hard. It's extremely hard to imitate that. Somebody made an observation and says the guy talking right now is Matt, not Jake. I think you're right. I'm Matt. All right. Okay, so Jake is an amazing guy. He helps people with the platform, with all the platform. He has patience that I've never seen before. I definitely did not have this patience as a broker as he does. So I'm very grateful that he's here with us. That's basically it, guys. So it went a little bit longer than we anticipated. I hope you enjoyed it. Again, go to community.optimusfutures.com. Ask all your questions. I'll be more than happy to answer the questions there. Jake answers technical questions as well, and we'll go from there. Okay. Would you know if Optimus Futures platform can be used from Canada? We are very limited on which brokers. Yes, we do service Canadian customers. There is a guy who I will not name. Okay, don't name him. Okay, because we're gonna bother him if we know him. Who turned $500 into $1 million, and then went back to 500 to do it again. I wonder if it's the scalability that makes him do that. I have no comment on things like that. You know, all those urban legends of a guy took 500 to $1 million. Did it happen here and there? Maybe somebody, you know, okay, maybe. But I don't use those examples to inspire me. I just don't. It's not what I do. Thank you for your time. I appreciate it. Okay. Yes, it was recorded, so you could definitely watch it. I didn't name him because it could be a conflict of channels. Honestly, I have zero interest of knowing who he is. Those people are not the ones that inspire me in terms of trading. You know, there's a lot of people out there that do inspire me, that are really good decision makers. Not all of them trade futures. You know, some of them just in the equities business, and some of them trade futures, and some of them trade stocks. But, you know, I look up to people like Carl Icahn or I believe James Simmons, you know, from Renaissance. Even Warren Buffett, you know, I mean, he's an investor, but there's a certain decision making that he follows, and I'm more interested in his decision making and logic. I know he's not going to teach me how to be a better day trader, but again, success has certain elements. So regardless of what they do, that's what they do. So again, I don't look at people who go through those kind of swings. And I'm not saying there's something wrong with them. It's not for me. All right. Okay. So that's basically it. This is all the time I have. And so, if again, the rest of your questions could be, could be directed on community.optimusfutures.com. And that's basically it. So I wish you all the best, and until next time. So have a nice day, have a great week, have a great weekend, stay safe, and take care of yourself. Thank you.